One of the most critical factors in token success is proper liquidity design, but it's often one of the most overlooked elements as founders focus on team allocations, fundraising, and market maker relationships. The reality is, poor liquidity ratios are what cause most tokens to actually go to zero. In this video, we're going to be diving deep into the fundamentals of tokenomics and what actually underpins the success of a project. To explore this topic, I'm hosting my friend, colleague, and CEO of Tokenise, a build, launch, manage platform that does your tokenomics end-to-end. He's a tokenomics expert with over 10 years of experience, and today we're going to be discussing some of the most critical challenges that face Web3 projects, both new and old, as they come into this new market. The purpose of this video is to go through each of the factors that makes tokenomics robust and simple and explain that in a way that's easy to understand and, most importantly, easy to implement. You're going to learn how thin liquidity leads to parabolic rises followed by death spirals, and why it's one of the biggest risks in token design, and some of those examples that we've shown demonstrate this in the last 12 months. Dan's going to share his story from working on projects from 2021 all the way through to 2025, the different types of projects that have shown different models with success, some less success, as well as discuss the fundamental gaps that exist between founders, community members, developers, fundraisers, and so on. Through recent examples like Virtual's protocol, we'll examine what happens when there's a focus on narrative over proper and robust tokenomics and how projects can avoid these common pitfalls. Let's dive into today's video. I hope you enjoy. Today, we're diving into the future of tokenomics. We've got Dan here, the CEO, co-founder of Tokenise. Whole premise of Tokenise is revolutionizing how projects design, launch, and manage their token, the whole economic life cycle. This is at a time when 95 to 99% of crypto projects are failing due to poor tokenomics design, and Tokenise is solving one of Web3's most critical challenges. What's fascinating is this isn't just a problem, but it's how the problem was discovered and the unconventional path that has basically led to the creation of Tokenise. Before we jump into Tokenise, Dan, can you walk us through your first encounter with tokenomics?
Oh, that's a great question. Well, I guess like the first proper encounter was when I was getting interested in the space and researching it. So like that was when I was doing a lot of stuff around like white paper research. This would have been back in 2019, sort of circa 2019, so a little while ago. And then when I started to actually have a contributive effect to a token economy, that would have been very early 2021, where we were working on a project called Moda at the time. It was a music DAO for, bringing fair ownership rights to musicians on chain. And that was my first real exposure to a project that was still being built. The economy hadn't been crystallized just yet. And it was a really good opportunity for me to learn, to contribute, and to understand more about what it was that made good tokenomics, basically.
When you were working with Moda, what specific the problems that came up that needed to be solved?
I think it was mostly so for want of a better word, most people still don't understand tokenomics very well. I think it's just because it's so math heavy and numbers heavy. And in my experience, just existing, like even in high school and primary school, I've always had a natural proclivity towards numbers and being pretty good at maths. And I also noticed that, 90% of my peers were not at that level. So I think in some sense, most people are just not in tuned to do maths well. And that's fine. That's totally human. Like I can't, I'm not a musician. Some are, So that was one of the problems I realized, was that not many people in the team knew how to do the tokenomics very well. And then the team that we were working with, who was helping us, they would be building out their tokenomics just in like Excel spreadsheets. And so that was the de facto standard. That's still pretty much the de facto standard, is that you just sort of build them out in Excel spreadsheets. But it's pretty intimidating, especially if you're building large scale models that have hundreds of different data fields. For someone as an investor, when you come to an Excel spreadsheet, none of them are going to look the exact same because there's no standard model that sort of applies. So you almost have to teach yourself how this tokenomics might work for this company and this company and this company. And one graph might be here on this page and one graph might be over there on that page. So there's no standardization. There's a lot of complexity involved. And so because of these innate barriers, people are less likely to want to look at building good tokenomics for their digital assets. It's just so much easier to go to Pump Fun and add 3 data fields and away you go. So Tokenise is the solution to that. We're making what is generally accepted as super complex, requires enterprise level expertise, and sort of boiling it down to its fundamental elements and just making it easy for everyone to use.
Were you realizing that people's eyes were kind of glazing over?
Yeah. I mean, even my eyes were glazing over a little bit. That's the thing. Like, even I was sitting there and thinking, good Lord, like, this is a lot. there's a huge amount of complexity here, and it was just not user friendly. Is the best way to think about it. It was just not friendly to me. It didn't feel like it applied to me. It felt like you almost needed to go get a PhD before you could come back and read it again. You sort of feel silly when you have to ask someone to walk you through what it is you're actually reading. So to take that and just make it simple has been a challenge, but it's I think in pursuit of solving a really complex problem.
Tokenomics itself, there's a lot of problems that come from poor tokenomics.
Yeah,
Right?
exactly right. Yeah.
I
And then,
mean,
of course, because you're not sure what's going on, you don't realize that you're building poor tokenomics. So
mm,
that's another big problem. Yeah.
and in a space that you've got the marketing and branding side and just the whole distribution thing, but like tokenomics really is, as far as it seems, like a core fundamental behind kind of crypto and Web3.
Yeah. It's the backbone of most Web3 projects, essentially. If you're building an asset, then in some sense, you probably have to have a look at tokenomics.
So
Even pump fund tokens have some sort of token economic model, which is the bonding curves, right? So you basically can't get away from it. It is the infrastructure that permits digital assets to exist.
let's start with the fundamentals. You mentioned a
Yeah.
few things with Pump Fund. I know a lot of people can get their head around bonding curves and what it means to do a fair launch. After your work with Moda, and we started to build Tokenise, like when a project founder would come to you, what were they confused about when it came to tokenomics, and how did you break that down to simple terms?
Well, while I was still after Moda's launch, I should say, after the Moda launch, we were working on a project that was based in Gold Coast, and the founder had a pretty solid idea of what he wanted, but it was more so about being able to communicate exactly what it was that he wanted to his development team. That seemed to be an interesting gap that we could help to solve for. So obviously when you're building out tokenomics, say for example you build a staking program. With staking programs, you have to build quite complex mathematics to ensure that your rewards are being emitted correctly over a given time period. There is, and then an additional layer of complexity is added when you're doing things like time decays or time locks or anything like that, right? So they can be quite complex. And so you have to find a way to be able to both run your company and build your company, and then also build complex mathematics that you then have to give to a developer and then say, hey, this is the maths that you need to put into the smart contracts for this to work properly. That's a lot. And so we sort of functioned as the bridge between the founder and the technical team in sort of understanding what it was that the founder wanted. The founder may have said something to the tune of, I want an APY of 100% per year. Okay, interesting. Now we build the maths to figure out if that is possible, and if not, what was the closest that we could get to it. Everything sounds good. You then take that and you give it to the development team. So that was one of the problems that we sort of found that we were solving. And again, it just comes back to the complexity that's involved in building the tokenomics, the time that's involved, the labor that's involved. There is a lot that goes into building a proper economic model, as I'm sure most people are probably aware of.
Yeah, there's the tokenomic build itself, but it's actually communicating what it is that someone wants to be built to then have someone actually build that thing. What is those kinds of questions that a founder would come to you and ask? Are they like, hey, I saw someone doing this. They've got tokens emitting to their community members. They can earn tokens by doing certain activities. How do we build that? How do we build that sustainably?
Yeah. Well, that's interesting. So you've sort of touched on a really cool point. So to go back to the previous example, we noticed that there was a gap between the founder and the development team.
Yep.
Now, where the product of Tokenise actually sits is not between a development team and the founder, because Tokenise essentially functions as a development team. There's the tokenomics built, the smart contracts are built, it's all done. We function as the bridge between businesses and community members. So now it's more about a conversation about, okay, so business comes in, they want to build some sort of token economic model, they want to build in some sort of high-level APY yield. We've built the product so that if you were a community member and you were trying to figure out what was going on with the tokenomics, you could visit Tokenise and you could understand the information. So, to case in point, take this screen as overview. So instead of seeing hundreds of different data fields all sit up in an Excel spreadsheet, this is left to right, what's your supply, How much are you raising at public fundraise? What's the public sale valuation? What price are you going to look at? What does your funding round look like? So this is information that is much easier to communicated to both community members and investors, instead of the business having to do it themselves. So that's where we've noticed there is a huge gap. It's also where we've noticed there's a gap, when compared to other offerings in the market. The community and business relationship is so important, and Tokenise ultimately aims to strengthen it.
If you're looking at that relationship between a project and its community, a project and its investors, between the project and its founding team, what are the biggest mistakes that you're seeing founders are facing, or the founders are making when it comes to their design and when it comes to this communication?
Yeah, it's liquidity. It's always liquidity. That is the biggest problem that I always find with founders. We at Tokenise, we have a liquidity first approach, basically. Our models are built on the foundation that you need to have good liquidity. Tokens, historically speaking, and when you look at trends and when you look at the data, low float to high FDV suggests that those assets will almost always trend towards zero. And what I mean by low float is when you have not very much circulating supply and, a very small liquidity allocation compared to a very high public valuation. So if your ratio is not correct, the data suggests you will trend towards zero. And for some reason, founders are not either aware of this fact or they remain intentionally ignorant of the fact. I'm not exactly sure. But generally speaking, when we talk to founders, they'll come to us and their first thinking is, how big is the allocation for the team? How big is the allocation for my fundraising? How big is my allocation for my advisors? How big is my allocation for my treasury? And maybe how big is my allocation for my community rewards? And then you say to them, what's your liquidity allocation? And they'll say, 1% or 0.5%. And it's just never enough. And so the biggest problem that I always find with founders is liquidity. One thing I want to add to that too is that there is a general impression that if you have low liquidity, this can lead to high value in terms of your token price. So let's break it down, right? So you've got really thin liquidity. When you have thin liquidity, buys and sells have an incredibly large impact on the price of your token. So because of this, we know that if you have thin liquidity and you see lots of buys, there's a good chance your token is just going to rocket upwards, the parabolic effect, right? And that's all a founder sees. They tunnel vision in. They think, I'm building the best thing in the world. I'm building the best tokenomics in the world. Everyone's going to buy this. Everyone's going to love this. They probably haven't validated anything, unfortunately. And they go out and they launch. And because of their thin liquidity, if they see a ton of buy pressure, they're correct. Token would go up. On the flip side, if they see any amount of sell pressure, token go down. And when token go down, people get sad, people FUD, you lose investor confidence, you lose holder confidence, and that creates death spirals, which will eventually just lead you straight to zero. So it's like the risk is just way too great. Don't worry about going parabolic. Don't try to have these large, huge buy swings. Build good, sufficient liquidity depth, which will absorb any buy or sell price impacts, and then build good tokenomics that will see slow trend up and towards the right. That's what you want. You want sustainability, not these parabolic roller coaster swings that you see all the time in the space.
When you take a liquidity first approach, is that reducing this volatility and ensuring that the token price stays stable? And when it says stable, it moves up incrementally and it moves down incrementally.
Yeah, exactly. So what I want to say is it's not necessarily about reducing volatility, because volatility can be good. You imagine if your price was going up every day, imagine it went up 10% and then down 5%. That's quite volatile. But if that's happening every day, you're netting a 5% gain. So it's going up, down a little bit, up, down a little bit, up, down a little bit. So those down bits are super healthy. It's part of a normal, healthy selling corrective market. So I don't know if it's necessarily about reducing volatility, but it is about increasing sustainability and increasing stability of price over time, if that makes sense.
Yeah, absolutely. Have you got any recent examples of a project recently that had low liquidity and kind of demonstrated these mistakes?
Actually, this is an interesting question. We reviewed Virtual's protocol it would have been 2 or 3 months ago, maybe. And this was at the time that they were sort of rocketing upwards and to the right. They were right in the epicenter of the AI agent narrative. But one of the comments I made when we were doing the review was that I felt the liquidity allocation was a little bit low, just based on the size of the project. And lo and behold, when the narrative started to shift away from AI agents, their price actually started to crumble. If I remember correctly, they sat somewhere at $4 to $5, and they're trading somewhere around $1.30, $1.40 last time I looked. But when I looked at them last, they were not trading at the same multiple that they were trading at. What are they sitting at right now? Yeah, $1.25. So like, and it's crazy, if you look at the chart, we called it. It would have been back in December, and the price would have been somewhere around $2. So they flew up to 450, and you just look at the chart. It's Mount Everest, basically. It's straight up, straight down. Now that said, though, I never say to people, it's because of the tokenomics, because there is the flip. Sometimes you have tokenomics that are pretty good, something goes wrong, but then over time everything comes back. IX Swap is actually a really good example of this. They had good tokenomics. They, died off in the bear market, but they've come back. They've resurged recently, and it's been awesome to see. So there's an element of the team doing a good job. There's an element of the product doing a good job. There is also an element of the narrative working to your favor. And in this particular instance, I think Virtuals was riding a lot on the narrative wave. And so since that narrative has sort of died off, potentially what's happening is not that Virtuals is a quote unquote, slowly dying project, but potentially the market is just pricing it at fairer prices than it was, if that makes sense. So less inflative, less bubble prices, and more, okay, Virtuals is doing something good, we're going to price this in at a more stable, more market reflective price. Yeah.
I want to look at another example. Do you know Chainlink?
Yeah. Yep. Stinky Linky.
Now,
Linky.
Chainlink, while they have an amazing value proposition in the market, being an oracle, they've been referred to as a gold standard in tokenomics.
Yeah.
Are there any kind of specific examples or lessons that we could take from Chainlink and extrapolate that out as to what makes that a good tokenomic model?
I think it's a lot in part due to how well the team have delivered on what they've built, to be honest with you. Like Chainlink is basically the standard in data oracles on chain. I feel like most large infrastructure companies use Chainlink as like their APIs, for example. They also built out their CCIP cross-chain interoperability protocol. So now you can sort of, communicate between chains. Like they've just gone really, really, really good at doing the infrastructure. And when you look at the price as well, the price is reflective of them continuing to deliver. They had that huge spike back in 2021, which would have been at the height of altcoin season. So that makes sense, right? People would have been speculating, price would have been reflective of that speculation. Then they died off in the bear market with everybody else. But they've continued to build and they've continued to persist, in my opinion. And then now the price is moving up and to the right. It's doing the right thing. So I think that if you're a project like Chainlink and you've built out foundational tokenomics that support your ecosystem, and you continue to build your product that supports the foundational tokenomics of your ecosystem, you're probably only going to see success in the long term. Short term, you'll get the volatile fluctuations, but as long as you stay calm and quote unquote dance through the storm, you should be great long term.
Okay, got it. I just want to zoom out. We've covered one of the main problems that a lot of projects have when they go to market is they're not liquidity first. They look at allocations, they look at how to make an ROI very quickly.
Yeah.
I want to more look into now, what's the confusion that people have between traditional economics and tokenomics? What are those key differences that I think I've seen that you've seen that people take from their traditional understanding and then try to apply that to a crypto market? What do people need to understand?
I think it's because a lot of people look through the lens of traditional economics with traditional metrics that you can sort of track company value against. So things like PE earnings, like ratios, EBITDA, all of those sort of very standard traditional metrics that suggest whether or not you're doing well as a company. When you're in tokenomics territory, the problem is that if companies launch a token, probably too early, none of those metrics exist to support any fair valuation anymore. And so what you end up doing is you end up building tokenomics that are relevant to things like attention. So you build your tokenomics, you build your valuation around the fact that you've got 100 million Twitter followers. Well, that, in some sense, I think is coming to an end. People have realized that Twitter followers and Telegram followers, it's all bots, it's all bought, it is easily faked. And so that also doesn't translate to fair valuation. What I'm seeing recently is that there are some AI agents, I think AI-XBT does it, where they scrape Twitter data and they'll look at things like how many mentions existed for a particular token, how much engagement was on a particular profile within a certain period of time. These are cutting edge attention metrics, so to speak, and AI-XBT attempts to find asymmetric plays where you can come in super early and then there's a good chance it's going to rocket upwards and you can make a really big profit. What I think the next step beyond that is going to be is a combination of finding ways to get PE ratios, EBITDA, all those things on chain in conjunction with attention metrics potentially, and then also intention metrics. And when I think intention, I think things like when you've built a community, say you've got 10,000 people in your Telegram, how many of those people are actually staking? Or how many of those people are actually liquidity providing? Or even how many of those people are actually holders? And so what I think we'll start to see a trend towards, and something that I want to be pushing at Tokenise, is looking at intention-based metrics that actually give a clearer picture as to the value of your community, and then by extension, the value of your project. So looking at things like how much by percentage of your holders are staking. And then by percentage, how many of those stakers are locked up for 6 months? And then by percentage, how many of those stakers are locked up for 12 months? And then by percentage, how many of those people are also liquidity providing? Because all of these actually show an interested, engaged community member. It's so simple to go to Twitter and like a post. It is not simple to buy an asset, go to the portal, lock the asset for a certain period of time, earn yield in that asset, even if you don't know if that asset is going to go up, and be happy that you're part of that community. That's a real fan. That's a real community member. And if we can capture that data, we can then start to value companies much fairer and much closer in line with fair market valuations.
Yeah, so it seems like there's a blend between a social, financial kind of economic model and a traditional economic model when it comes to...
Yeah. What I think is happening in real time, actually that's a really good point. What I think is happening in real time is that 10, 20 years ago, investment banks like JP Morgan Chase would value companies. Now, if you have enough of a populist concentration on Twitter, they'll value the company.
Interesting.
That's where I think things are trending towards. Social valuations rather than traditional institutional valuations.
In light of some recent examples, when projects are representing their tokenomics to their community members, whether they're community members on Twitter or Telegram, that kind of stuff.
Yeah.
I mean, if we're looking at social valuations now and people comprise of those, what should founders present? What should founders communicate to their community? How do they go about that?
This is interesting because I've been watching this happen in real time for the past 3 days. One of our clients has presented some tokenomic options to their community, and the community have been a very mixed bag. Sometimes the problem with just chat rooms and with people who exist in chat rooms, and I guess sometimes people who are, not exactly eloquent, so to speak, is that they're very, very quick to cut down any potential ideas without any proper critical analysis or proper critical thinking. And what I think that means is we need, as builders and as project owners and project founders, we need to do a better job at breaking down complex information so that it's much easier understood. Because to the point of the first part of the video, not everyone gets tokenomics. Not everyone should have to get tokenomics. It's not everyone's burden to bear. So as people like us at Tokenise, when we're building these digital assets, our focus for the long term is to make this so simple, easy, that you can break down these complex topics, that break down the complex jargon, and make it simple for people to understand. So a good example of this, instead of saying things like, this will vest over 1 year, it's more like saying, you're going to get 5% of your tokens unlocked each month. You know, so much more simple, so much easier to understand. Not everyone knows what vesting is, fair enough. And so it's our job to make it easier for people to get. And I think through doing that, community members will be able to make better informed decisions about the value of the companies that they're part of.
You raised something really interesting there in communicating these complex topics, and you specifically mentioned vesting schedules.
Yeah.
I'd really love to explore how Tokenise helps projects do this. And in doing so, I'd love to just bring some attention over to one of the features on the Tokenise platform here, where we've got vesting schedules here.
Yeah.
And how we can view these vesting schedules visually as well.
Yeah.
Can you walk me through and how, like me as if I was a founder and for other founders, how they could use some of these tools and how they can communicate these vesting schedules to their community members?
Yeah, so the way that we've sort of done it, and what's interesting about the vesting tab specifically, is that we've got a big update coming from a UX perspective. It's actually going to be much simpler and much easier to understand. What we want to start to do is trend towards visualizing the data rather than just saying the data.